Mugdha Kalra.
A very good evening, ladies and gentlemen. As the great Warren Buffett once said, opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. And tonight, we are here to prepare our buckets because the world of investments is brimming with opportunities waiting to be seized. Welcome to the HSBC presents HSBC India Investment Summit, Alternative Investments and Global Markets in association with CNBC TV18.com, Mumbai chapter. I'm your host, Mugdha Kalra. India stands at the crossroads of extraordinary growth, where private markets and alternative investments are emerging as powerful engines of wealth creation. And at the same time, global markets continue to reshape financial strategies, demanding bold decisions and a keen understanding of future trends. Tonight, we will decode these complexities, offering insights that are actionable, forward-looking, and designed to give you that edge. Brought to you by HSBC, a global leader in wealth management and private banking, along with CNBC TV 18, this summit promises to be an evening of insights, ideas, and inspiration. And now, ladies and gentlemen, to set the stage for this evening, I would like to invite Sandeep Batra, Managing Director and Head International Wealth and Premier of HSBC India, to deliver the keynote address.
Thank you so much, Mukta, and delighted to be here today. I think, not a surprise, HSBC has been around in India for a long time. I think that long time now is about 170 years. Just this weekend, we celebrated 100 years of a single branch in Calcutta. So clearly committed, long-term, focused, participating across businesses in the corporate bank. We serve about half of India's unicorns, half of India's multinationals. A large percentage of FX moves through us. Continuously investing into the business. We are scaling up our wealth and personal banking business. We launched the private bank just last year, brought it back to India in 2023. We acquired L&T Asset Management in 2022. So clearly a lot happening. Just 2 weeks back, we announced entry into 20 more cities in India. RBI allowed us to give 20 more branches. So you will see a lot more HSBC across, as you crisscross the length and breadth of India. Now, we are obviously here not to talk about HSBC, but we are here to talk about the wonderful investment opportunities around the world. We have some of the best and sharpest minds. We will talk about alternates. Now, alternates is a very broad term, but we will try and decode some wonderful asset classes within that. Who doesn't want to participate in the wonderful, thriving startup ecosystem in India? And we will talk about how could you get opportunities of investing into that? What are the themes around that? What are the themes around private credit? We will see how interconnected the world is becoming. Just in the last 2 to 3 days, you'll see Monday morning you come in, you see one app around the world causing large financial sell-offs in a part of the world, and then a comeback. So clearly a very interconnected world. So as we gather these very sharp minds, I'm looking forward to a wonderful sense of interaction. Let's make it interactive. Let's make it fun. Let's get started. Thank you so much.
Thank you, Sandeep, for setting the stage for the evening. Ladies and gentlemen, we now move on to our first panel for the evening. It's titled Market Outlook 2025, India and Global Perspectives on Economic Trends. Now, as we step into the new year, the interplay between global dynamics and India's growth trajectory is taking center stage, with markets facing headwinds from inflation, evolving global landscape, geopolitical shifts and crises. It's critical to understand how these trends will shape the economic landscape in 2025. To dive into India's market potential, the global factors influencing it, and strategies to navigate this dynamic environment, I would like to invite Prashant Nair from CNBC TV 18 to moderate this panel. And joining him on stage are, put your hands together, for William Sells, Global Chief Investment Officer, HSBC, Global Private Banking and Wealth. Abhilash Narayan, Investment Strategist, HSBC, Global Private Banking and Wealth. And Sri Ram Ramanathan, CIO, Fixed Income, HSBC Mutual Fund. Over to you, gentlemen.
Thanks very much, Mugdha, for that. Thanks, gentlemen. It's great to be here. Good evening, ladies and gentlemen. Thank you very much for being here. It seems to be a packed house, and I think why not, right? So the topic is market outlook, and I think we're only in the initial sort of couple of months of 2025, and we are already sort of, in the unknown in that sense, right? We're all deep-seeking now, to use a pun, about what really is going on. I mean, actually, to be fair, till 3 days back, I didn't know what deep-seek was. I don't claim to be an expert now, but I've read up a lot. But I don't think anyone still knows whether what the implications, et cetera, are going to be, whether this is going to be relevant a month from now, whether we will even remember what has happened over the last couple of days because of this. So it's a very interesting environment. It's always a very interesting environment, I think particularly so because markets over the last couple of years have done extremely well. And of course, last couple of weeks here in India has not been all that great. So we'll discuss all of that. And I think we'll start first with the global outlook, especially with regards to the US market, which by far has been the best performing market over the last few years. William, let me start with you. US first, right? I have to ask this, is DeepSeek a threat to US exceptionalism?
Well, the US remains our favorite market, and in part because of our economic outlook. I mean, we can show this. First, I have a few things to show you. The global economic outlook is strong, is resilient for the US, and to a very large extent because of that innovation that is happening in the US, because people have been underestimating, economic growth in the US for quite a long time. We didn't get that recession, and in fact, we also, even more importantly for markets, we are getting that earnings growth, and that is spreading. So even our message, even before the DeepSeek news, has been don't just focus on the Magnificent Seven, because actually what you see on the graph there on the right-hand side is the acceleration in earnings is actually elsewhere, is in the 493 stocks, and that is because of that productivity growth, falling cost pressures, etc. Now, one of the big drivers of economic growth and innovation in the US and around the world is going to be that whole AI ecosystem. And again, what I emphasize here typically is that it's not just the chip makers. I actually think that the infrastructure around it and the beneficiaries of that innovation, the adopters of AI, are going to be the big winners. And what you have in the US is really that policy priorities and that innovation coming together, being reinforced by whatever Trump wants to do. So, broaden the thought process when you're looking at AI. Don't just think about NVIDIA. Think about the beneficiaries, the adopters, and also on the right-hand side there, don't just look at the US. There are, other markets where you have that innovation. Don't just look at public markets. We're going to talk a lot about, private markets as well, where you see that innovation. Just to complete that point, Willem, you're saying it's not just 500 stocks? It's not just 7 stocks. It's the other 493 which have also been accelerating. Exactly. Because, we typically only talk about those 7 names, the Magnificent Seven in that sense, right? Exactly. The forgotten 493. Those are going to see that acceleration in earnings and therefore that support. Okay. And you're saying it's going to happen now because of the policies of the new administration, or it's already something which is happening but has been missed so far? So the earnings acceleration is coming now, as you saw on the graph just before, and that is in part because of the lower interest rate costs, in part because of productivity growth. The the wage inflation obviously is coming down as well, and that all supports that earnings acceleration. Okay, let's talk about tariffs now, right? So will we see? I think initially he's going to go big with tariffs. Now, a couple of weeks after he's taken office, Trump has taken office. The general mood has been that, well, there's a lot of talk, but we'll see what is finally done in that sense. Do you think eventually we will see substantially higher tariffs, universal tariffs, or
It's going to be specific products, specific industries. What are your thoughts?
I think it is a negotiating process, and therefore it will probably be less bad than, you know, the worst case scenario, but you are going to see tariffs. And in particular, obviously, you see there the overview behind me of the countries that could potentially be most vulnerable. And obviously, you also need to take into account that this is mainly going to be on goods. So this actually saves India to a large extent, right? Because here we have the services exports. But we are going to have that negative effect, especially in terms of sentiment on those that are the target. So Mexico, the EU, especially as they don't know how to fight back in the case of the EU. China, in our view, is only is going to be in the eye of the storm there as well. The Chinese government will try to offset that by local stimulus, by domestic stimulus, but it's only offsetting. I don't think you're going to have an acceleration in activity in China, and that's why we remain neutral on China, even in spite of the very low valuations.
So do you have a sort of tariff level in mind, or you think it's going to be 10%, or it's going to be, or? I
think indeed, as to your question, I think it is going to be, in many countries around the world, it is going to be relatively product specific, relatively targeted.
Okay, all right. Let's come to the Fed now, right? That's the other one. I mean, actually, it's tonight. We've got the Fed decision coming out, the latest one tonight. So we'll wake up to it tomorrow morning. What are your thoughts there?
For us, no move today. We think that you're probably going to get this year 2 or potentially 3 interest rate cuts still. And to a very large extent, this is because there are, on the inflation side, a number of offsetting factors. Clearly, tariffs are inflationary. Clearly, kicking out people out of the country and creating a problem in the labor market is inflationary. But the strong dollar is deflationary, and potentially oil prices come down as well, because he said, drill, baby, drill, right? So more supply on the oil side. Therefore, I think inflation remains capped below 3%. That allows the Fed to cut a little bit. The problem is that this is already what the market prices in. So you're not going to get that much of a price gain or a rally in terms of the bond market, and you're going to get lots of volatility. So on the bond side, we're very tactical. We think you need an active approach, and actually that's across the market, that I think 2025, that volatility means that people need to be quite active, either through a manager that is active, or our advice that is active, or a hedge fund.
No hike, right, though? No hike, right?
No, we don't have hikes penciled in, because you would need to have quite a significant impact on the tariffs, for example, and you still have quite a significant real yield at this point, a compensation over the current level of inflation. Inflation is also coming down. Rent, for example, is coming down quite significantly in the US, which people are ignoring. Rent inflation. And that will allow the Fed to.
But you said only 2 or 3 rate cuts through. That's what's essentially what you're expecting in 25.
Yeah.
So 50 or basis points. I mean,
yes,
approximately this year.
Exactly.
All right. Let's talk about opportunities in, public markets, private markets, as you were referring to earlier. People always complain about valuations now more than ever because markets have done so well. Where are opportunities, especially on the private side?
So on the private side, first, what I'm highlighting here on this chart is that 85% of the companies in the US that have more than 100 million in revenues are in the private markets. So if you're not invested there, you're missing out on a lot of opportunities. And to a very large extent, this is true in many of the economies around the world. There are entire sectors that are not really that represented in the public market. We also think that you're going to have much more activity in private equity this year, in part because you have a lot of corporates, trade buyers potentially, that are sitting on a lot of cash that can now borrow at cheaper levels, and that see that, that gap in valuations between public and private markets. So they want to arbitrage that. M&A and IPOs are still 40–50% below normal, but we think that is going to increase. Also, the US administration is much more friendly to M&A than the previous administration. So I think that is an area to look at. The other area that we really like is infrastructure, and it comes back to the AI bit. Clearly, infrastructure is not just about roads and bridges, it's also about electricity, and we know that we are going to need every single potential way of producing electricity, including, just an example here, clean energy. where, you know, the increase in demand has led to economies of scale, the progress in terms of the technology as well. So I do think that regardless what Trump is going to do on clean energy, it is part of the solution. But a lot of need for infrastructure, and interesting for investors because quite often the return is linked to inflation. So if you do have an hesitation around this, that this could hurt, inflation could hurt a portfolio, infrastructure is a partial hedge.
Okay, the other hard asset are precious metals, right? Gold, etc., has done phenomenally well. Do you think that continues to shine?
For us, it is part of a well-diversified portfolio. I'm not too optimistic in terms of the directionality. We rather have it going sideways, in part because of that strong dollar, which is a headwind, and also if the Fed only cuts 2 times, then that tends to be an obstacle for gold. But it tends to do well in periods of obviously geopolitical risks, and that obviously does exist. This is a world that we live in, therefore it does have a place in a portfolio.
Any thoughts on Bitcoin, Willem, since I have you here? At HSBC, do you have a view? Bitcoin? I mean, crypto?
For us, it's not an asset class because it is like a chameleon. It changes its shape. Sometimes it goes with gold. Sometimes it goes with, you know, the technology stocks. It's not very closely linked to the dollar, to interest rates, to inflation. So it's not an inflation hedge. I would push back on that. And as we cannot model it, we don't have it as an asset class. We get a lot of clients' questions, though. So I think it is becoming more mainstream. But I would advise if you put it in a portfolio, clearly make sure it is a small element of it, because clearly it's very volatile. It can swing the portfolio quite significantly.
No, absolutely. I think the Trump administration likes Bitcoin, right? I mean, that's the other thing. Mainstreaming it is, as they're calling it. What are the big trends, Willem, according to you, in 25? 3 big trends, and I guess it's gotten very muddy and unclear, right? Especially it's a multipolar world. Everybody's pulling in different directions. So what, according to you, are the 3 dominant trends?
So indeed, I do think that you have indeed that multipolar world, where a lot of the economic blocks are competing with each other. Really look at manufacturing, which is very competitive, and where if you don't have an industrial policy, like for example Europe, you're going to lose out. And so German manufacturing, for example, is very much under threat. India is trying to do this and really you know, upscale and be a new entrant on it, and has an industrial policy. So I'm quite optimistic around that. That obviously links it to the infrastructure, which is my second trend, together with the energy independence. If you want to compete, you want to have your resources secured. So the energy transition is not just tree hugging and sustainability. It's about having the energy and the electricity that you need. So it's national security in a way. And the third element, in terms of big trend, I do think that AI-led innovation is a big trend, but it's again very much more than just the chips. It's the automation, it's the cybersecurity, it's all of those elements around that. And I think they actually reinforce, those 3 trends reinforce each other.
So manufacturing, there is energy, and there is AI.
Yeah.
And energy, you think we'll see something come up as a dominant thing? I mean, again, under the new administration in the US, renewable is kind of taken the back seat, or will take the back seat.
But it will need to be part of the solution. You cannot do without. I think it is part of the solution, together with nuclear, together with, you know, still the gas-powered power station and so on. It's also, to a very large extent, you know, the building out of the grid, the interconnectivity. In lots of countries around the world, and in Europe, I know this very well, there are periods where you have very low prices of electricity in one country and very high ones in the others, because it's not sufficiently connected. That's going to a big area of investment. So there are lots of aspects. So always think about not necessarily the first degree problem, but all of these sort of beneficiaries, the second derivative beneficiaries of it.
Because India is investing a lot, building out a lot of capacity in renewable. I mean, wind, solar, and so many sort of new companies, both in the listed, unlisted space as well. So you think that is a space which will continue to grow, despite, I mean, that's very much in the mix in that sense, right?
Yeah, I do think that is the case, yeah.
All right. Let's move on to Asia, Abhilash, which is your area of specialization. And let's start with tariffs. We still don't know what is essentially going to happen, as William also said. But it's generally understood that India is, because we don't have that much exposure to the US, we're less affected by whatever comes in terms of tariffs. Your first sort of high-level top-down thoughts on tariffs.
Absolutely. I mean, when we think about Asia, it is considered the engine of global growth, but tariffs, especially for China, are a key risk. But overall, we think that Asian growth, especially Indian growth, will be quite resilient. And one of the factors behind that is, the fact that most of the Asian economies have very strong levels of private consumption. And that means that they are less exposed to exports and potentially more resilient to any imposition of tariffs. Now, within Asia, one market that we like is Japanese equities. Obviously, it's well integrated into the AI ecosystem, both from a software and hardware perspective. Wage growth, as you see on this chart, is increasing. And we have seen, ROEs of companies improve there. Apart from that, we are bullish on Indian equities, and we can talk more about that later on. And we also like Singaporean equities because we think that they're a good dividend play and can be an income-generating assets as, global rates come down.
Absolutely. Let's talk about India a little bit, Abhilash. What's your sense? Tariffs may not hurt, but higher tariffs don't necessarily help, right? So at the margin, do you think the global environment has become a little more adversarial for India, and we, in any case, find ourselves in a bit of a slowdown right now?
Yeah, I mean, if you look at the tariff threat, obviously we don't think India is at as much as a risk as some of the other countries. And as William mentioned, Trump's focus on tariffs is mostly on goods. And for India, services are a larger part of the exports. So that way, there is a bit of a hedge for India. Yes, we've seen a slowdown in the economy, and that's gathered a lot of attention recently. But I think we need to take a step back and look at the bigger picture. We expect India to grow at 6.5% this year, which is much higher than the 2.7% global growth that we are expecting. If you look at some of the catalysts that are on the horizon, we think that rural consumption is showing signs of picking up, especially after the strong monsoon season. We are seeing high-frequency data like PMIs, industrial production being in the positive territory. And we do expect an acceleration of government capex. So we think that the growth should stabilize around 6.5%, which means that India will be the fastest growing major economy for the next couple of years. And we do expect India to become the third largest economy by 2029.
We got the union budget on Saturday. Do you think that will provide any help? Do you think we need help?
Well, to a certain degree, as I mentioned, we do expect acceleration in government capex. As of November, we had only seen 46% of the budgeted capex for FY25 being spent. And that's understandable because, it was an election year. Now, for the next year, we think that the government will continue on a path of fiscal consolidation. So we are looking at 4.4% fiscal deficit. But we do expect that the government will maintain its focus on high-quality capex, measures to boost consumption in rural sectors, measures to attract FDI, and potentially the job creation initiatives that were announced in the previous budget.
No lower taxes?
Well, that would be the cherry on the cake.
No, absolutely. The other part is flows, right, here in India. FIs have been sellers, big sellers, but locals have been buying. Retail has been a big theme over the last 3-4 years now, non-stop. The SI discretionary is lumpy, but the SIP book has been absolutely steady, rock solid. But, it's a question worth asking. We've not had a down year for a long time now. We've not had a long period of underperformance. How confident are you that this retail sort of flow will be steady, will remain steady, and will not start to panic if there is, say, a year of underperformance, which is possible?
That's a great question. So I think, yes, we have seen FIIs pull out about $19 billion. And if you look at the chart there, that's coincided with the pullback in Indian equity markets. But I think that the outflows have been driven by a combination of profit taking and the concerns around growth and concerns around INR weakness. But to me, the level of sell-off we've seen is starting to look a bit excessive. If you just take the example of concerns around INR weakness, what we see on the next slide is performance of Indian equities adjusted for INR weakness, so returns in dollar terms over the last 20-25 years. And Indian equities have outperformed both global and US equities over that period. And that's because of the strong, fundamental earnings growth that the companies have delivered. And we think that that story still remains in place. As far as domestic flows are concerned, FII flows are about 3 billion a month. And we think that that has room to run further, because when you look at Indian households, they are underexposed to equities as compared to, households in US and Europe. So there is more room for Indians to reduce the money that's kept in fixed deposits and invest in the markets, which in the longer run does offer better return potential.
I think 12% dollar returns last 25 years, right? I mean, in India.
10-ish, yeah.
Yeah. Earnings, Abhilash, what is your sense? You think earnings growth will... there was a sharp slowdown in the second quarter. Third quarter, October to December, expectations were there's going to be zero earnings growth. But I think till day before yesterday, there is about earnings growth is running at about 12%. So it's running better. Do you think we'll end 25 on a slightly better note as compared to what people were penciling, and then 26 expectations will be what, 15%?
Yes, so we are looking at mid-teens kind of earnings growth for calendar year 2025, 2026. And clearly, I mean, with this sell-off we've seen, earnings delivery will be under spotlight. But when I think about the downside risk, I think it's very, very important to look at the state of the overall economy. So we talked about the fact that Indian economy should grow at around 6.5% on a real terms. But on a nominal basis, that's growing close to double digits. So that, to me, caps the downside risk as far as earnings are concerned. And I think one of the related questions is, is it a good time to enter markets, right? Or should I wait? Should I take profits? And what this chart shows you is that timing the market is very, very difficult. And if you do get the timing wrong, it can be very costly. So over the last 25 years, Indian equities, MSCI India has delivered a return of 9.6% on an average, on an annual basis. But if you were to miss the best 25 days, so on an average one best day per year, the return would be 2% per annum because of the compounding effect. Now, you'd have to be really, really unlucky to miss all those 25 days. But it just shows you that if you do get the timing right, if you try to sort of sell and then buy at the lows, and if you get the timing wrong, it can be, quite detrimental to long-term returns. So, I would start looking at the current sell-off as an opportunity to slowly buy on dips and average in.
What sectors, Abhilash?
So, from a tactical perspective, we like healthcare, financials, as well as industrials. So if I look at healthcare, that was one of the best performing sectors last year. And we think it's supported by structural tailwinds. So as India gets more affluent, people are willing to pay for better healthcare services. And the spending on healthcare as a percentage of GDP in India is much, much lower than what we see at a global level, as well as, the developed markets. If I look at the hospital beds in India per 10,000 people, that's much lower than what we see in China and Europe. So that is an area of structural growth. And then when I look at the sector, you do get an exposure to both pharma companies, hospital chains, and diagnostic services. So it is a defensive and a diversified exposure. If I talk about industrials, obviously it's been a beneficiary of the government's Make in India initiative, the Viksit Bharat initiative to increase exports to 2 trillion by 2030. And one statistic that really stands out to me is mobile phones. I mean, 5 years back, India was manufacturing only 25% of the phones sold in India. Today, we are manufacturing 98, 99%, and we're actually an exporter of mobile phones. So we think that, industrial sector should continue to do well over the next 6 to 12 months.
I think 16 crore Android phones every year now in India.
Yes.
So it's exported. And which is the third sector you said?
Financials. So
financials.
I think, it's a sector which has lagged in the recent times. There have been concerns around margin pressures. But we think that should be manageable. The asset quality is starting off from a good base. And it's a sector that's trading at a steep discount to the broader, Indian market. So it could end up being a value play. And if concerns around, growth slowdown and credit growth slowdown sort of dissipate over the next coming months, then you could actually see a catch-up rally taking place in that sector.
Lovely. Sriram, let's come to the fixed income market here in India. So we'll get the Fed decision today. Actually, over the last many days, whenever we've had people come up on the show, or come up on our shows, we asked them what the expectations of the budget are. They said, well, forget the budget, let's watch what the RBI does. And then, of course, the RBI did ease liquidity up a little bit. We'll hear, I don't know if something new from the Fed tonight, but what's your sense on rates here in India?
I think over here, clearly one is we have to keep a very close eye on what's happening globally, especially the US Treasury market. We've already seen since October the pre-run-up itself, Treasury yields really moving significantly higher, currency moves, etc. So that uncertainty, I think, is something that we are going to deal with over the next few months and years as well. But having said that, we don't think that's a very big negative influence as far as our Indian markets are concerned, fixed income markets. And the reason for that is that, if we see where India is as of now, and if you, let's say, go back 12 years and see where we were in the 13-14 taper tantrum days, at that time when the US Treasury yields sold off by 150 basis points, I think it went from 1.6 to about 3%. Our markets yields went up by more than 2%. We moved from 7% all the way to 9.1, 9.2%. Now, if you look over the last 3 months, Treasury yields have moved up 100 basis points. Indian bond yields have moved down by about 10 basis points odd. So that shows clearly that, at least as far as our bond markets, fixed income markets are concerned, I think what matters for us a lot more is what's happening domestically. And that's really the interplay between growth, inflation, obviously RBI, the change of guard, all of that comes into play. So I think we are actually fairly positive as far as the Indian fixed income markets are concerned, even though we need to keep a very keen eye on, obviously, what's happening with the global bond markets.
I mean, you mentioned the new dispensation at the RBI. You think they will see some, a change as well in terms of what we see? Liquidity, we don't know the stance. We'll get to know on the 7th of February, but
Correct.
What's your sense?
I think it's early days. Obviously, we haven't seen or heard enough from Mr. Sanjay Malhotra, but the initial indications do suggest that I think it's a much more aggressive approach to tackling some of the issues that are coming up now. I think, for one, we have seen, especially on the currency side itself, allowing the rupee to be a little bit more volatile and maybe price in some of the moves that are happening globally so that we don't stick out like a sore thumb and ask for trouble later. Apart from that, I think clearly the trends that we've seen in terms of a little bit of growth moderation, and importantly, food inflation now coming off very, very significantly, right? I think that's a big move that we have almost seen the entire food inflation spike get reversed in December 1st, and in Jan, we're expecting a further significant moderation in food inflation. I think that gives the RBI governor enough room, and the Monetary Policy Committee as well. So our expectation is of a 25 basis points cut in February, followed by another one in April. More than the rate cuts, I think liquidity obviously is an unexpected change for the worse. It was not as per plan. Almost 4 lakh crores has been drained out because of the currency predominantly. And I think RBI needs to do a lot. While they have done the recent announcements in terms of open market operations and all, we are still looking at a significant negative liquidity even now, which means that they need to do a lot more. The sense from his actions suggests that we are going to see an action-packed February 7th policy.
And when you said aggressive, you mean aggressive in tackling some of these growth challenges in that sense?
Yes.
Not
exactly.
inflation, growth. I mean, growth is the priority.
I think balance clearly now has shifted. In fact, the inflation number for January, we expect to be significantly below 5%, closer to the 4.5%, 4.6%. I think that really takes off the one reason that RBI had earlier to wait and watch and see for data confirmation. I think now it gives them enough room. Now, I think for the RBI, it's a case of erring on the side of aggression rather than caution. I think that's the switchover that we are likely to see from RBI. But we'll see how it goes.
No, absolutely. And on the currency, I think it's a good point that you make, right? I mean, not to stick out like a sore thumb. It helps foreign flows as well, because why should money come in from abroad if the anticipation is that the currency will weaken?
Absolutely.
So I think that is also happening now. They're letting the currency
I think that change, subtle changes, or rather it is fairly visible, I would say. But at the same time, if you really see, I think there's a lot of noise around the currency, INR depreciation, etc., while absolute levels are all-time at its weakest. But the fact of the matter is we are still really amongst the better half of currencies even now. Importantly, if you see volatility, despite this recent moves, the last 1 year volatility, INR still stands out as the least volatile currency globally. So while we are getting a little bit more volatile, we are a far cry from the true EM currencies, which are 3 to 4 times more volatile than the Indian rupee is.
The inclusion of government bonds in sort of global indices, right? FTSE, MSCI, Bloomberg, etc. How do you think it'll happen? And actually, we already have a timeline in that sense, right? How will that change things, in your opinion?
No, I think that remains a very positive tailwind, I think, for us. And the good part is these are the typical real money EM funds. So while, like we saw in October, November, we did see a little bit of moderation in FPI inflows into bond markets. like we saw in December, it came back and it made up for some of that. So I think the $25 odd billion that, let's say, the JP Morgan GBI EM is supposed to bring in, we think that's on track. We are now at about 18 to 19 billion of inflow since September 23. So that's a good amount of inflow. And the other two indices we think should lead to about $8 to $10 billion of inflows. So between now and March 26, I think that's still a good $15+ billion of incremental flows into our bond markets, which just makes the demand-supply situation continue to remain fairly positive as far as our government securities markets are concerned.
Okay, gentlemen, thank you very much, all of you. I just want to ask you, just last question to you, William. You know, this President Trump's policy, America first, is it going to be at the expense of everyone else, or you think eventually it will be not? It'll be sort of...
Well, I do think that he's, you know, an aggressive negotiator, right? You know, there are other terms for that, but, you know, they will put pressure on you know, a lot of the other countries around the world. Now, if for example, it triggers, you know, a reaction in other countries to also, you know, really go for that global competition and put their house in order. I'm thinking obviously of Europe that really needs to be shaken before they do something. You know, ultimately it could be a positive for their longer growth model. But I do think that you're going to see, you know, lots of ups and downs in terms of the sentiment in the market, and for the lags, for example, on Europe, first a move down before then they act, and you could see that in other countries too.
Lovely. So it looks like it's going to be a macro year, right? With lots of ups and downs.
But also lots of opportunity on the single stock level. I mean, we've already seen the DeepSeek, etc., which then creates that opportunity for that active management.
Absolutely. William, Abhilash, and Sriram, thank you very much, all of you, for sharing those thoughts with us and the audience here. I hope that was useful. Let's open it up for a couple of questions. If the audience, anyone in the audience has a question, please raise your hands, and I think they'll get the mic to you. Do we have, I think we can see. So do you have a question? Yeah, please. I think they'll get a mic to you.
Hi. So considering the launch of DeepSeek, do you suggest to invest in the tech stocks or tech market? Or how do you see the outlook going forward?
Indian tech or?
Both Indian and US tech.
William, yeah, or Abhilash?
So from a tech perspective, so you know, there is a lot of debate whether US tech is expensive and whether the US market, therefore, in general, is expensive as well. I do think that, you know, to a very large extent, when you look at the PE differentials between different countries, they're explained by two factors. One is the sector composition, right, where you, for example, in the US have a lot of tech, and in the UK you have, you know, consumer staples, and you have financials with trade at lower valuation. The second bit is the ROE, the return on equity, where US companies are just much more profitable per unit of equity capital that is put to work. Where what we put our emphasis on, what I've tried to convey, is that technology, you know, there is a big gap between the very large technology companies and others, mainly being the beneficiaries of technology, or even smaller stocks within the technology side, or in the private markets, which we are going to hear a lot more about, you know, where you can take all of that enthusiasm around technological innovation, but do it at lower valuations, more of a sector spread, and obviously much more diversification on that basis as well.
That was an excellent discussion. I have a question for Abhilash. With regard to India's growth outlook, apart from the electronics sector and healthcare, for private capex growth outlook, which are the other sectors you anticipate they would be a positive spurt the next 2 years?
Actually, that brings a good point, right? Private capex has been quite lackluster in India for the past few years, and you know, at the moment, it's difficult to see what could actually spark that wave of private capex, at least in the next 6 months. I mean, let's wait and see for the budget to come through, but I think in the near term, the focus more would be on the government capex coming through for infrastructure and other high quality users. And for now, tactically, we think it makes sense to position for winners of that government policy coming through. So for us, industrials is one sector that we like to position to benefit from that bit of government capex.
Anyone else? I think, yeah, please. Right there, mic behind.
I'm asking this question on behalf of non-residents. The fixed deposit interest rates for non-residents is about 7.5%, for which no tax is payable. And we have seen a good run in the equity markets in the last couple of years. I believe that, for the year 2025, the returns on the equity market probably would not be more than 10%. That being the case, do you think it is advisable to just put in fixed deposits and get an assured 7.5%, rather than get 10% and then pay long-term capital gain tax, which will probably give us similar return then?
It's a very fair question, and we have a lot of clients who are making that reflection. Certainly, if you look at the last 2 years, we already had that question. Should I be in cash? Whilst the diversified portfolio did 14% in 2022 and around 12% in 2023, and then 12% in 2024. So where we stand now is a cash rate, of around just below 5% in the US, and a bond market where you can get just a little bit more than that if you buy and hold. And you are in the high quality paper. Clearly you can add a little bit to that by trying to be tactical, but that's the comparable return that we're looking for. From a US equity perspective, we're looking at around a 10% return. So what a lot of clients are doing is actually relatively cash-like instruments or short-dated bonds, and then the barbell approach of the second panel that we're talking about. Adding to alternatives, because there, obviously, the valuations are lower, the opportunity set is very big, and we think that you're going to see much more activity. So that barbell approach is a very typical and very popular answer to your question, I think.
Okay.
Yes, please, right behind.
What would be your expectations with the budget, and how do you expect the management of capex at one end and all the freebies which are being spoken about in terms of schemes like Ladli Behna and all, where they're doling out money? Also, there's a lot of push for private income tax, personal income tax to be reduced. So where will they find the funding?
Okay, maybe let me start, and Sriram, please feel free to add. So, as we discussed, we think that the government will remain on path of fiscal consolidation. We do project 4.4% fiscal deficit, and you're right. Where does the government find money to sort of fund all of those spendings, both in terms of discretionary spending, but also capex? So I think as far as capex is concerned, we'd probably get similar level of capex budget as we got last year. Bear in mind, this year we'll probably hit around 85% of the budgeted capex. So, even if the government keeps the same budget for next year, there is still room for capex growth on an actual basis. We think there's room for the government to potentially reduce the discretionary spending to a certain degree. And when you factor in the GDP growth that's taken in, there should be a modest increase in the overall tax revenues that comes through. So overall, we think that the fiscal math should add up and help the government target a lower deficit than we saw last year.
And I think there was one, I can't spot you where you are, the person who asked yes, sorry. I think the other one was about welfare schemes, right? Schemes like Ladli Behna, etc. That's also something which a lot of investors ask all the time. Are we going to see more and more of those kind of schemes? So spending on social schemes is about 2% of GDP. It has been that around that level for the last couple of years. Do you think we will see that? Do you see that rising, and is that a risk at all, in your opinion?
Well, I don't know whether they'll rise, but that's clearly a risk to the overall fiscal trajectory. right? But I think one good thing is that we've seen that the government has been fairly disciplined when it comes to trying to meet the targets that have been set. So I think that gives us a bit of comfort. So even if the spending on some of these benefit schemes increase, we do expect that the government will try to balance its books in other ways to ensure that India's debt trajectory remains fairly healthy.
Sorry, I interrupted you.
Yeah, no, maybe just to add a couple of points. I think as far as the center is concerned, like Abhilash mentioned, with a more or less enough tuning in of the markets to this 4.5% kind of reduction in fiscal deficit, there's not that much room for the center really to do a whole lot more. I think capex will continue at about 11.5 lakh crores. But I think the whole welfare thing is more becoming at the state level. And I think that's where, and maybe it's not such a bad thing, where the states really focus on a lot of these schemes and try to really, we call it freebies or whatever, but try and get the bottom of the pyramid more into it. And while the center, I think, focuses its role in terms of capex. I don't see the central budget really doing a whole lot on that side.
You know, I can tell you, every year there are expectations, lots of expectations with the budget. I mean, you know, some standard which are rolled over from one year to the other, but this year generally expectations are quite low. I mean, I don't know. I think you guys agree, right?
Yeah. Hopefully we get positively surprised.
Hopefully. I saw one hand right behind. Yes, please. Please.
So this is to Sriram. Sriram, you mentioned that the rupee has been the least of volatile currencies when it compared to the other currencies. But you also mentioned that the RBI is tapering off from interventions. Data points suggest that the rate has been managed most of the times by RBI intervention. So if RBI is removing itself from the OMOs, do you foresee that it would cross 90 or maybe even cross the century mark?
No, I think, like I said, I think, I think overall, as from a macroeconomic perspective, we are and we continue to be extremely strong, right? It's a reasonably well-growing economy, and all our defenses are very much, our current account deficit is still in that 1.2% kind of a number, fiscal deficit-wise it is, and all these matter because that's where your vulnerability really comes out, which we have seen happen to us in the past. Unlike those episodes this time around, it's really we are in a fair position of strength. The only thing that we are really saying is that if there is a global trend of dollar strength, wherein a lot of currencies, and especially, let's say for us, the CNY matters a lot, if there is a particular trend in terms of, let's say, 3-4% kind of weakening, the INR can't really buck that for too long. And it's really that kind of a catch-up that we are talking about. So if we were, let's say, the way our economy was 12 years back, hypothesizing about 90, 95, 100 and all, obviously would be on the table. I think right now we are more, at least our sense is it's more 3-4% kind of weakening, annual weakening, which is a little bit more than what we maybe were expecting some time back, which would be more in the 1.5 to 2% kind of a weakness.
Sriram, dollar CNY now, crossing 8 and all is out of the window, right? I mean, it's not, or you think that's still a risk?
I think the risks are there.
I mean, depending on what comes out of...
The currency side has been, I think after the initial build-up that we had seen in terms of dollar strength, obviously things have stabilized a bit, and I'm sure William can throw some light on that. But I do think the currency element is still early days, and I think we are going to see currency play a very important role, especially with tariffs and various negotiations coming in. So at least I won't rule out CNY really being part of the playbook as far as China is concerned, if at some stage they really need to offset some of the pain.
Absolutely. Sir, please, right here in the front. Can we get a mic to him?
Thank you. So I'm going to ask a mischievous question. Some time back, there was a lot of talk about de-dollarization. Now with Trump coming into power, do you think there's going to be any distance traveled along that journey?
William. De-dollarization was a big talking point, but do you think with Trump in, we'll go in the reverse direction now, re-dollarization?
Sorry to bring up Europe again, but you remember, the difficulties that the Eurozone was in a number of years ago, and it hardly, was kept together. And that for a number of countries, that is very, very similar. So if you're thinking about BRICS, it's impossible to launch a currency with economies that are so different and that are even politically actually not very homogeneous either. They have very different agendas as well. I do think, though, that there is more trade being done around the world in other currencies. China certainly wants to try to do that. The reserves of the central banks are being diversified as well, but there is no challenger to the US dollar, I would say.
No, unchallenged is the verdict here. Anyone else, please? Question? Right here in the middle.
Thank you. Hi. The defense sector was a flavor of last 2-3 years. Now, considering the geopolitical situation changing now, do we see the impact on the capex spending in this budget on defense sector? Or it will remain stable, or it will go sideways, or?
So in our very complex world, if you want to call it that, diplomatically, I do think that, one of those, I talked a lot about national security, and I talked about energy, supply chains, and all of those kind of things. Clearly, defense is also part of that. And what we've done so far, the weapons that lots of countries have sent to Ukraine are stuff that, was relatively old, that they had in inventory. Now they need to replenish that. That's number one. On top of that, Europe has certainly realized that they need a better defense as well. So I do think that there is going to be a lot of spending on this. We have this in a theme which is, around travel and around what we call around cybersecurity as well. We have lumped it in that. We have a difficulty as a bank to cover a lot of defense stocks where we want to stay away from that. But certainly it is a sector that has macro support, that's for sure.
Thank you.
Abhilash, you have any thoughts? Defense stocks here in India?
I mean, the whole indigenization sort of initiative is a structural tailwind. Obviously, when markets do really well in the short term, there is inevitably a period of consolidation, and that's probably what we are going through. But I think the structural trend towards more self-reliance is not going away as far as the Indian stocks are concerned.
Absolutely. Any more questions? I think we've gone on for a longish bit. All three of them, of course, are going to be in the audience. So after the next panel discussion, you have the opportunity to sort of pick their brains. Thank you very much, all of you, for being a wonderful audience and those great questions as well. Thank you, gentlemen. Thanks very much.
Thank you, gentlemen. Thank you so much for all the deliberations. Well, that was Market Outlook 2025, Indian and Global Perspectives on Economic Trends. And thank you for the wonderful questions that the gentleman from the audience also raised. All right, with that, we are moving on to our second panel discussion of the evening, which is called Breaking Down Alternatives, Investment Trends, Unlocking New Opportunities. Now, alternative investments, including private equity, venture capital, and private credit, are transforming the investment landscape in India and the way we do business. With their potential for higher returns, risk diversification, and funding innovation, these trends are emerging as cornerstones of modern portfolios. To uncover the key drivers behind the growth, the evolving landscape with their opportunities, and the strategic role these investments can play in building resilient portfolios, I would now like to invite on stage Surabhi Upadhyay from CNBC TV 18 to moderate this very special panel. And joining us on stage, put your hands together for Anshu Kapoor, CEO and MD Nuvama Asset Management, Neeraj Karya, CEO Private Credit Fund Kotak Alternative Asset Managers, and Prashant Jain, founder and CIO 3P Investment Managers. Thank you. All yours, Surabhi.
Good evening, ladies and gentlemen. So do we have the audience's attention? Alternatives, right? I think it's a very, very interesting topic at all times, especially now. If I could just play on the word itself, given where the equity market, the listed equity market is, I think everyone's looking for an alternative. Is that not right? But gentlemen, great to have you here to sort of dive a little deeper into understanding this asset class, where we are in India with respect to it, and really what are the opportunities perhaps ahead. So let me start with some opening thoughts, get the panel's view on the drivers behind alternatives as an asset class and where Indian investors are in that journey. Anshu, let's open with you.
Sure. Thank you, Surbhi. Well, let's try and demystify this word alternatives and maybe give a top-down view of what the asset classes are, what the size and scale is, and what is the relevance, more importantly, for this audience. So what's happened in India, and things become really big and then we get to notice them, right? What's happened in India is alternatives as a category has been growing for the last 15 odd years. I'll give you some numbers. India's market cap, we all talk about it, is $5 trillion. Mutual fund industry is, let's say, about $800 billion. Private equity invested capital only for the last 10 years is $300 billion. This is twice the FPI net investment in India over the same time. FPI has put in $150 billion, private equity is $300 billion, right? Commercial real estate is another $200 billion. Commercial real estate, maybe on that point, India is globally relevant. We, as a country, absorb 50% of Asia Pacific's commercial real estate demand every year. So a city like Bangalore in the last 5 years has consumed as much commercial real estate as Shanghai. Imagine the size and scale difference. So you are also globally relevant, and these asset classes earlier were built on the back of dollar capital. All these endowments, foreign funds, institutional investors, they came into the country and they built the size, the scale, the sophistication, and so on. Talent got built on top of that. And then came, the AIF framework, the alternative investments framework, where over the last 5 years it gathered momentum. We started to hear about it, talk about it, and magically from 10 years back, we are at $150 billion of AIF funds in this country.
That's across Cat 1, Cat 2, 3, Cat 3,
all categories put together. But that has been the explosion in all of these categories. And finally, there are asset managers or product providers who are now building products for the Indian audience, right? I'll give you just one quick example. Let's say globally private equity is a 10-year product. And when we first devised our first private equity fund, and I went to clients like yourself, you said, listen, I'm not going to give you 10-year money. I don't know what's going to happen in 10 years. Private equity, come on, no. So we built a 4-year product for the Indian customer. So the problem was that there was demand, there is demand, but supply is still catching up. And someone in the audience asked a question from an NRI perspective. You don't have access today. So that is slowly being plugged in. So you have size and scale, sophistication, you have talent, you have a great regulatory framework, and finally, products built for you. So I think that is the kind of size, scale, and the relevance of this asset class.
Okay, very interesting. Prashant, your thoughts on how this asset class is moving along and also sort of competing with the regular listed equity space and PMSs and the regular mutual funds?
No, I think alternates is a fairly broad term, and there are spaces in which mutual funds typically don't play, like credit, like unlisted. And even in listed equities, alternates can bring in greater focus, greater customization. And I think this is an evolving space growing rapidly. And our share of alternates is still much below what has been experienced globally. So I think this is here to stay and grow, and I think it should be looked upon as a great complementary product to the mutual funds.
Okay. So a good complementary product, not necessarily competing, but could be a great complementary addition to portfolios as well. Neeraj, your opening thoughts?
So while there are comments made for the broader AIF industry, Let me take private credit because that's not covered. I think Prashant and Anshu have already covered on the equity side. So on the private credit, it used to be a very small industry, maybe even 3 or 4 years back, let's say pre-COVID, right? Average deals in India used to be about $2.5, maximum $3 billion. 60 to 70% of that used to be done by global funds, and they used to generate about 20% IRR. This whole segment, which was effectively available for dollar capital, the Indian investors did not have access to in the
If
past.
I could just request you to keep your mic a little
Yeah, they
high
did
up
not
so we
have.
can all hear you. Yeah.
Sure. So they did not have access to at all in the past. Today, that has completely changed. If you look at 2024 numbers, total deals were $10 billion. They're, of course, smaller than the equity sizes yet, but they're $10 billion in value. Equal amount has been raised from domestic investors to invest just last year. There were 76 funds that were launched between 2019 and first half of 2024. 13 of that were just launched this year in the first 6 months of the in 2024, first 6 months of the year. So clearly on the demand side and on the investor side, there is acceptance for Indian money investing in private credit. This whole segment, which used to generate probably 18 to 20% return for dollar money, generates somewhere around 14 to 16% for INR money, and which is
14 to 16%.
14 to 16% gross, which is great from a return risk reward perspective, especially in times when the market is volatile. As somebody just said that they believe that the market will generate 10% in the current year. So if a product generates about 14 to 16% over 3 years on a compounded basis, it actually is a great product and it finds its space in the portfolio of investors.
Absolutely.
The flip side always is that the private credit asset class is illiquid, and that is the flip side of this asset class.
We'll talk about this and go into some more details because those are fantastic sort of return numbers that you've shared, and that's three-year CAGR return, so nothing to sort of ignore out there. Anshu, so let's break this down. There are so many different elements and segments within this basket of alternatives, right? Private credit is one. There are long-short funds, long-only funds. There's commercial real estate, as you said. So from an Indian perspective, which ones are, and there's private equity, obviously, which ones have really matured, have scale, size, and relative safety in terms of, liquidity, easy exits, etc. So how would you sort of classify the basket?
Yeah, if I were to give you a top-down ranking in terms of, and also we need to see where the access is available, right? Where good quality products and funds are available to the investors. The size and scale might still be there. So I think private equity is the most vibrant. The reason I say this is that, and we have all seen this in the last 3-4 years, the kind of companies that are now listing on the exchange, right? About 50% of the IPOs that happen in this country are actually offer for sale by private equity. So that just tells you the depth and the size and scale and the maturity of the market. Yeah, there is early stage and venture and angel and all of that, but going from mid to late stage, it's a very vibrant ecosystem. Liquidity is available as exit to IPO. It is also available that I can sell to another fund. So there are a lot of counterparties, a lot of funds in the ecosystem today that are available for you to give liquidity, if that was the requirement. So I feel comfortable offering solutions like this to Indian investors, right? Obviously, suitability and other things. The other interesting asset class with a lot of margin of safety, but products are few, is infrastructure actually. In roads, in transmission lines, where size, scale is there, and actually, if you were to look at it, counterparties tend to be central government agencies, right? The third very interesting asset class, again, with not many opportunities to deploy, very few high-quality funds, is commercial real estate. The IRRs, when we underwrite those projects, are 20-25%, right? And earlier, foreigners have made a lot more, by the way, in this asset class, with a lot of margin of safety. Why I say this? Because 99% of this audience is interested in real estate. And many of us have tried to invest in commercial real estate on our own in many forms, but with varying degrees of success. So now there are opportunities available.
And then emerging ideas like private credit and long short and all those are available. So that would be the pecking order in my mind.
So just to follow up on private equity, and we'll try and cover each of these segments in a little more detail, time permitting. Private equity, obviously, that's really hot. I mean, forget this, esteemed HNI or ultra HNI audience. Everybody wants, a little bit of action in the unlisted space, right? We all want to own unlisted shares now and say, I had Swiggy before the IPO. So that's the mindset, right, in general. But again, talking about between early stage, mid-cycle, late stage, where do you see, the best relative risk reward within private equity? Which kind of sectors? Where do you see the action for the next at least couple of quarters?
That's a great question, Surabhi. Thank you. And yeah, it's becoming a popularity contest. And that is when most mistakes are made in investing. See, our thesis has been a little different for this audience and this investor base, is that we have taken a call to stay focused on building the late stage private equity ecosystem. The reason being, Surabhi, that even large companies in India compound at 15, 20, 25%. But they may be, let's say, 4 to 5 years to the IPO or 3 years to the IPO. And Indian markets, so then you don't take mortality risk. You're not taking business execution risk. The product is there, the team is there, the company is scaled up, all of that is there. So business is unlikely to die, right? They need capital for growth. There are special situations for which they need capital, but there is a clear path or stated path to IPO. There, your risk underwriting is far more superior and then the tenor of the product tends to be 5 to 6 years. You're not taking a very long tenor that in 10 years things can change. So our thesis has been that. The second thesis has been we are not sector focused. We are not deep tech or robotics or healthcare or retail. We follow India as macro, so consumption, consumer brand, consumer tech, all of that will come in that. Then we will follow financials and we'll follow, let's say, emerging themes like manufacturing, enterprise, and tech is an enabler for us, right? So that is the big call we've taken to kind of give margin of safety in a very dynamic world.
And you still see, valuation's still okay, relatively speaking, in some of these late stage private investments.
In private markets, you still get to see reasonable valuations.
Which now brings me to the listed space as well. And, Prashant, weigh in on everything that you've been hearing. Clearly, private markets are very exciting, even on the equity side. Your thoughts on what you're seeing in the private space and then the listed space itself, right? Which anyway has been going through pain last couple of months. What do you see ahead and what are you advising, people who come to you?
So I think my understanding of the private space is not up to the mark, so I would leave it to him. But coming to public markets, I think in fact, we released a note yesterday itself. I think the large caps are offering decent value. And the indices have corrected about 12-13%, and there has also been roughly a 9 months time correction. So PE multiples are reasonable. Indian markets are now trading about 17 times calendar 26 earnings, which I think is reasonable because India's cost of capital has dipped sharply. The gap between India and US 10-year yield is at an all-time low of 2.2%, which tells you how cost of capital has moved lower. However, I would be extremely cautious on the small and the mid-cap space.
Even now, despite the fact that they've corrected maybe 30-40%, in some cases more?
I think that space is still very stretched to my mind, and I would be extremely cautious in that space.
Within the listed, space, Prashant, so you have long-only funds. Coming to alternative asset classes, there's the concept of the long-only funds, and you can sort of use the regular mutual fund route. There's PMS. So why should one consider the alternative asset fund, even for listed market equity investing?
So I don't think it's either or. Fundamentally, the underlying assets are all the same. I guess an AIF comes closer to a mutual fund because both are pools of assets. And the PMS is like someone else is trading on your behalf. So that way it is a lot more complex in terms of filing your tax returns, etc. And I think from a compliance perspective, for someone working in senior positions in companies or business owners, and AIF and mutual funds are clearly preferred because these are, you are not trading on your account, right? Now, I think AIF pays the tax. So when you sell the AIF, you don't have to pay tax. So to that extent, it is probably simpler than even in a fund. I think the real difference can come from greater focus, greater customization in smaller setups. And over time, I mean, the real issue is that whether AIFs are able to outperform mutual funds, which only time will tell.
So we were talking returns, right? We had Neeraj saying that some of the private credit structures can maybe yield up to 14, 15%. We have Anshu saying that commercial real estate can go up to 20%. What about good old listed equities, given the environment, Prashant?
So I think they are, I mean, if you believe what they are saying, and there are no ifs and buts in that, then I think listed equities promise a lot less. So I think India is now a lower inflation country, and I don't think there is any room for margins to go up in India. That's what I feel. So I think longer term Indian markets, profits in India will compound around 12%. So multiples I don't think have room to go up. But equities offer you very concessional rates of taxation. So to what they said, you should also look upon it on a post-tax, post-expense basis. Then I think the gap would be probably a lot less. But as we always say, there is space for everything in a portfolio. Because
so to just complete the picture, and since we have you right here with us, given the macroeconomic challenges, I mean, domestic slowdown concerns, I'm not even getting into what Mr. Trump is doing or what the Fed is going to do overnight, but just talking about this, specter of growth slowdown here in India, coupled with this almost non-stop FPI selling, what do you expect ahead in the listed market for, say, the next couple of quarters?
So I think the slowdown in India is because Indian households have leveraged a lot more in the last few years. And it is now showing up in the rising NPAs in the low ticket, lower end of the consumer loans. And RBI has been kind of trying to slow down the personal loan growth. So to that extent, I think this slowdown is welcome because it will lead to more sustainable growth in the longer term. So I think one more issue which India is facing is that while our gross FDI is holding up extremely well, the net FDI is down sharply because we have a first in India now that multinationals are paring down stakes in India. So whether it was Hyundai or 10 other companies, because the Indian valuations are pretty expensive. So net FDI in India is quite low, and that is also showing up in the rupee dollar market. So I would be not too concerned with this slowdown because otherwise the health of the corporate balance sheets, the bank balance sheets is extremely good. I think the central government is very committed to fiscal discipline. But I would certainly temper my expectations of returns from equities along the lines I said earlier.
Okay, sobering thought there. That's sort of the real picture that Prashant is putting out. Fair enough, got that. Now let's come to private credit. I myself started hearing this buzzword, I think just 2-3 years back. After COVID, like you mentioned, Neeraj, that's when it seems to have really taken off. So we want to understand what are the exciting opportunities, who are these issuers, which are the hot sectors. But before I get to any of that, I always look at the risk profile of any investment very carefully, alongside the return conversation. So whether it's liquidity risk, and we all remember the past cycle, right? I mean, most of us would easily remember what happened during the IL&FS period, before that, et cetera, et cetera. So what about credit quality risk, liquidity risk, when you're looking at this IRR of 14, 15%?
Yeah, so different houses or different fund managers play this segment in a different way. And right now I'm just speaking about performing secured credit, corporate credit, right? And of course, there are other asset classes like real estate credit, there is infrastructure credit, there is venture debt, and there is special situations. So leaving those aside for a second, if we just speak about corporate secured credit, right? Why should a company actually borrow at 14, 15%, right? Conceptually. So there are pockets where you can make this kind of money, either because of what I like to call as duration risk, or because of lower credit, so hence higher credit risk, right? So these are two ways effectively you can make more money. That is the way you can make more money in credit. Lower credit, we've seen the impact in the earlier cycles, right? Looser terms, going maybe up to a leverage level of 4 or 5 times EBITDA, over-levering the company, and seeing where it actually lands up. As Prashant said, we are seeing that in the consumer Indian segment right now. We've seen it in the past in the mid-cap and the large-cap segment also, at the corporate side. So that is one way to make money. Say, a company is highly levered, you take a call on it that it will do better, and you give them debt at 14-15%. The other way to make money is, in our view, is to just play duration risk. And that is a risk we like to take. We try and avoid higher leverage. We try and make money out of duration risk. What it means is that a company that can actually, let's say, finance its acquisition or capex plans through equity today, right? But as Prashant said, the market is volatile on mid caps. It may not like the valuation in the public markets or in the private markets, what Anshu may offer them. So then they would come to us and say, can we borrow at 14-15%, which is effectively a bridge for 3 years, right? And I don't have to repay the loan for 3 years, but I'll keep paying you coupon for 3 years. And then at the end of 3 years, he pays us back everything, either through the cash flow or through raising equity at higher valuation. This is the risk we like. We like funding growth. We don't like funding high leverage, but we like funding growth. We like companies that are taking a bet on themselves. And hence, effectively, we are playing on duration of 3 years. To take that risk of 3 years, you have to underwrite, of course, better, right? Now, this is from a risk perspective that we add to the portfolio. But from an investor perspective, the biggest risk comes out is the liquidity risk. Because it's higher duration, right? It is a hold to maturity product, which means we have to hold it for 3 years. And hence, we cannot liquidate it when the investor wants the money back. Sure. We have to actually hold it till the whole term. And that's how we can actually deliver that kind of return with lower risk in our view.
But, and since, as you mentioned, you're avoiding companies which are, over leveraged, companies which have maybe balance sheet issues, therefore, the risk of any sort of a default at the end of that maturity period is probably minimal, right? Because this is primarily a duration risk you're taking?
Primarily, we fund growth companies and we fund duration risk. That is the way we think about it. Counterparty risk is the biggest risk in India, right? From whichever way you look at it, right? Prashant will tell you, Anshu will tell you that, look, the management quality is the most important, whether you look at debt, equity, whatever it is, right? So from that perspective, you support a company that is growing well and you take a 3-year risk on them that they will pay back after 3 years. That is the best risk to take rather than doing business with a company that is 4 times levered, 5 times levered and charge them 40, 50.
Okay, which also, makes me wonder whether then this is a very bottom-up approach. I mean, our equity experts here will always talk about the bottom-up approach rather than taking a top-down sector view that you want to do private credit in infrastructure or in green energy. So that's not the way this goes. But having said that, I mean, are there any sectoral trends that emerge?
Yeah, I think the sectoral trends are similar, whether it is debt or equity. We heard that even earlier in the day. We like healthcare the best. Our view is that healthcare grows at about 18% per annum, and that is considering everything, right? It could be for export, it could be domestic supply, it could be healthcare services, all put together in our view. If you put all the segments together, it grows at a very high rate. That is one sector that we really like. Across all our funds, maybe 30% is always allocated, or 25 to 30% is always allocated to healthcare. Industrials we like better, but again, there are pockets of industrials that are good right now and some are not. For example, auto comps, there are some companies that are good, some companies that are struggling because OEM sales are lower on the two-wheeler side. So healthcare and industrials, definitely. But we love the mid-cap space the best, actually, right? Because from our perspective, these companies grow at least at 2x the rate of GDP. So let's say GDP is, let's assume for the next 10, 15 years is 6 or 7%. We believe mid-caps will easily grow organically at 13 to 14%, right? Which means if there is growth, the reality is that growth hides a lot of perils, right? And if you support growing companies, again, it comes back to the same argument. Mid-caps are growing. They may not find the valuation attractive in the equity market, so it becomes a play for us.
On growth, if we are in a bit of a growth slowdown for the next couple of quarters, would private credit be affected pretty much the same way as equity because of the slowdown is a slowdown? Or would the risk for private credit be a little higher if indeed we are in a prolonged economic slowdown?
So, of course, there is a risk of any cycle that hits the industry. So, from that perspective, there are some deep cycle industries that we don't touch. For example, EPC we don't touch at all. Right? There is nothing in our portfolio that touches EPC. Industrial, hence we are very selective. Which part of industrials we play, which is also cyclical industry. Financial services also we are selective. Like we've not done anything in our portfolio which is unsecured consumer finance, as Prashant also spoke about. Like if you see the charts earlier on mobile phones that are being sold in the country, 40% of that is actually consumer finance of 40 to 50,000 rupee loans, taking individuals who are taking loans, right? And these guys sometimes don't even make 40 to 50,000 rupees a month, right? So some of these trends you watch out for. Anything that has a little bit of too much float in it, you try and avoid. But conceptually, this is a secured product, right? So typically, whatever your loan is, you would secure it on an average. I think at an industry level, we secure it at 2.5 times. We generally operate somewhere between 3.5 to 4 times in terms of security. So through cycles, we actually push for a little bit of money back. We don't need to get the whole money back, which we do. We've done it also in the past. And hence, conceptually, across cycles, credit, if you do it the right way, could be a better product.
I think we're almost out of time before we open it up to the audience. So, gentlemen, now that we've understood what all, this basket of alternative investments encompasses, quick take on how to blend them with a portfolio, how to do the right balance. And also, we're in an environment where risk mitigation is also really important. So, to what extent can some of these AIFs perhaps help in that whole risk mitigation exercise? Anshu?
Yeah, I guess like with any investing strategy, diversification obviously helps here. But you should know that all of alternatives, most of them come with illiquidity risk. Equity markets, you can sell tomorrow and be on cash. So if you are investing in alternatives, the primary risk you take, other than the asset class risk, is illiquidity. So you are locked in for a period of time, so that you should be careful about. And for rest, talk to HSBC, they will help you, right?
Prashant, your advice on blending alternatives along with traditional investments in a portfolio?
So I don't think there can be one answer to this. It would depend on the answer would need to be very customer specific, and I think the wealth managers are best positioned. But I would like to add one thing, that when it comes to listed equities, at least, I feel the risk is very low. The volatility is there. And most investors don't differentiate between volatility and risk. So listed equity, I think the rate of business failure is extremely low. And therefore, to that extent, in a growing economy, I believe listed equities offer lower risk, though volatility cannot, of course, be avoided.
Absolutely, take that point. Neeraj, your thoughts? And also, you folks have to give us, now Prashant has made his point clear that, listed equity, slightly lower return expectations and lower risk. But I want the two of you to give us the hottest, AIF tip for 2025. Neeraj?
Kotak fund. Simple.
Slightly broader. Slightly broader than that, yeah.
Yeah. So, look, the way I think about it is, we saw the numbers even earlier. I think the Indian investor has not played the private market enough in the past. So I think AIF is a great way to play it. Whether you look at it from a medium-term or long-term perspective, even listed equity, I'm sure the way Prashant runs it is more long-term, right? So anything that is private and longer-term from that perspective is a great way to balance the portfolio, in my view, right? Because it takes away all the vagaries. Second, I think from your total debt allocation, if you allocate some bit to private credit, it brings some stability to the whole portfolio. That is our view. It compounds return from that perspective.
Anshu?
Yeah, so maybe I can answer this differently. Number one, Surbhi, I think the allocations are very low. Like I said earlier, the access to these asset classes has not been there. So my request will be for all of us to take our time, build awareness, take our time, don't rush in, see what the quality of the manager is, what's the track record, how have they done recently, And you would agree that mistakes are made mostly in times of euphoria and in times of panic, right? And I said that, do not get carried away by this popularity contest. So while there is a fund, some brokers will come and show you 5 deals also. And there is a huge amount of temptation, influence of the crowd, and so on and so forth. So don't try and become that alternatives fund manager yourself. Like I said, like Prashant said, equities you can sell and at least cut your losses. Here you can be stuck. And if you are doing this on your own, you do not have much rights. You cannot influence, you can't do anything.
Okay, what's going to be the, the highest IRR generating alternate investment over the next 3 years?
It's hard to say, but obviously equity or equity-like, private equity has to be out there, along with the listed markets, I would say. So that's my advice.
All right, so there you go. Private equity, private credit, and then, of course, the good old listed public markets as well. Thank you very much, gentlemen. This was very, very interesting. And I think we'll have some time for a few questions from the audience as well. If anyone has questions, thoughts, any interaction you would want to share with the panel, I think, yeah, we have a hand there.
Hello. Can you throw some light on the disclosures and transparency in these investments?
Disclosures and transparency
to the investors.
Okay, fair enough, fair point. Like the panel mentioned that we do have a regulatory framework for AIFs now, 3 different categories, 1, 2, and 3. But do any of you want to
so maybe I can quickly take this up. Sir, actually we are fortunate to have a very good regulator that is very progressive and also has given the right flexibility to the investment managers. As far as disclosures are concerned, or all the practices, governance, all the policies are concerned, I think we are evolving, but what we have today is very good. So you should take comfort in that whatever we are doing in the regulatory ambit is very high quality.
Actually, speaking of regulation, Neeraj, if you could throw some more light on this. While obviously SEBI is the overarching regulator, but for private credit funds, is there any oversight of the Reserve Bank at all, or no, the central bank doesn't get into it?
Currently not. We are this one unique animal that is governed by RBI and SEBI both, because we're a subsidiary of the bank. But on the other hand, rest of the industry is largely SEBI driven. But I echo Anshu's sentiment. Look, I think the regulatory framework, look, the reality is that the regulator is very watchful of any smaller or medium investor that comes into any capital pool, right? So as private credit is also growing, there is a lot more regulatory framework that comes with it, and that will keep increasing. And that's good. We completely support it.
Any other questions? Any comments from the audience?
I have a question on private credit. Specifically, what has been the delinquency ratios over a period of time, considering that this has picked up recently in India, considering also that generally it is secured with good quality of collaterals?
Yeah, it's a great question. The reality is that it is still to be tested, because I don't think we've seen one full cycle yet. Right? We've not even seen one full cycle of harvesting of the first funds that were probably raised from 2020. Right? That's the way to look at it. I think as we go along, a lot more track record will be available. One thing, we tell investors, and when people even ask us for personal advice, is that it's always useful to see an institutional backed, at least, fund on the credit side. And second, it's always useful to see higher proportion of sponsor capital in the fund, which basically just shows higher commitment from the institution to ensure that there are no losses. But the reality is that the cycle has still not gone. I think in about 2 years you'll be able to see a full track record of fund managers to be able to take that call. The total quantum that has been raised till now, I would say, is about $10–15 billion. So that is still to be harvested.
Fair enough. Any other questions? I think there was someone right at the back who had a question. Yeah, if you could just put up your hand. Okay, there.
Hi, good evening. An amazing discussion. And we have been hearing about the fact that illiquidity is the biggest problem in terms of unlisted securities. So what can we do about it in terms of regulation, etc.? Maybe having an exchange for unlisted securities, a few birdies have been tweeting about the same, that the regulator is looking at starting up a platform for unlisted securities, trading unlisted securities, etc.
Yeah, fantastic question, sir. Thanks for raising that. I'm going to take this up with you.
Thank you so much for asking this. I would say all of this is work in progress from a regulatory standpoint. Right now, for you to better manage your risk is to go through a good quality fund. That is what my advice will be, because you may get lucky in a few instances where, things go well, things go your way when you buy single securities, right? But there is a risk. There is a very high degree of risk there, and that you should be very careful about.
And correct me if I'm wrong, I remember doing some conversations around this, but shareholder rights in the unlisted space can be very, very different, depending on, stage 1, stage 2, series A,
also
B,
the
C.
nature of instruments.
Yeah,
You're not buying up your
yeah.
equity stock instrument. It could be a convertible, it could be something else, which you may not be able to understand the fine print. And you will never be able to enforce. You can't just go there and say, okay, here is my
shares and please give me the money.
So it has to be dealt with caution, is what I would say, and that is private equity. You're doing a commercial real estate we talked about, but still at least you will hold the property in your name, and a lot of regulatory improvements have come, like the SM REIT and the REIT framework and so on. So as you can see, this is all evolving in the right direction, unless a fund or a vehicle has a SEBI stamp on it. My advice will not be to go for it.
All right, I think we've gone on for a long bit, almost 9 o'clock, but thank you very much. Very, very interesting discussion, and all three of you made sure that though it's 9 p.m., I think all of us were completely glued to this exciting conversation and this exciting universe of alternate investment funds. Thank you very much.
Thank you.
Thank you, Surabhi. Thank you, gentlemen. Well, that was all about alternative investment trends. And now we come to the final session of the evening. It's time for a very engaging fireside chat titled Big Screen to Big Investments. Now, this session is a fascinating exploration of how creativity, vision, and entrepreneurial spirit can transcend industries. It's about the journey of a serial entrepreneur, the visionary chairman of Oberoi Family Office. He actively leads investments in diverse portfolios of businesses, including edutech, fintech, agri-tech, media and entertainment, real estate, and sustainable luxury. His vision prioritizes both profitability and purpose. Recently, he was awarded an honorary doctorate recognizing his contribution to entrepreneurship and social impact. And as a committed advocate for ethical business practices, he focuses on creating social impact through his investments. Deeply believing that business can be a powerful force for good, he continues to shape a future where profit and social responsibility thrive together. He is the only Indian actor to be recognized on the Forbes 40 Under 40 Heroes of Philanthropy list. He is also actively spearheading numerous charitable initiatives pursuing scalable impact. Ladies and gentlemen, Vivek Oberoi in the house. Right. What an impressive body of work, first of all, I must say that.
Thank you.
And such varied domain interests. It also makes me wonder about kitni hazaro khwahishein aisi. right? And it almost makes me ask you, was acting an accidental career? Because clearly this looks like entrepreneurship is in your DNA.
I think the reason I became an actor is I always wanted to play different roles.
Mm-hmm.
And now I'm playing them in the boardroom as well. But it's been an exciting journey. I think I discovered that I wanted to be an actor very, very young. Maybe I was 5 or 6 years old. And I was like, this looks like something I want to do. Mom was completely against it. She was like, Padho likho, Bollywood is extremely volatile. I don't want to expose my son to this degree of insecurity. So it was good at studies, incidentally. But I think it was my father who at a very early age infused the seeds of entrepreneurship. I remember when we used to go on these fancy holidays, summer vacations, and I was about 10, 11 years old. He would delay the vacations by about 2 weeks and say for these 2 weeks, he would just buy me product. Right? I remember one year it was electronics, one year it was perfumes, one year it was apparel. Every single year it would be those 2 weeks of a clinic where he would just buy me product, make me make an account in a little khata book that this is what I have in terms of inventory, this is what it costs me, this is what I have to pay my father back, and then everything else is my own pocket money. And he was serious about it. And there was me when all the other kids were playing. I was carrying inventory in a school bag, on my cycle, riding the streets of Juhu, knocking down doors, and taking customer feedback at the age of 10, 11. But those seeds that I think I have my father to thank for, taught me so much that I apply in terms of business even today and decisions even today.
It's so fascinating to see how parents shape so much through our childhood. And it's interesting because Senior Oberoi is, of course, a leading personality from Bollywood, and I would have never thought that he would have made you do all of these things, which is such an incredible lesson in parenting.
It was tough love, Mugdha. We had 3 cars and 3 drivers in the house, and he was like, oh, here's your money, go by bus. Learn life, tough it out. And I'm really grateful for that today. I think it made me a lot more balanced.
I would want to know, how are you as a father? Are you the same? But, given that this helicopter parenting generation is much kinder towards their towards their children, I think I'll skip that question, keep it for another day. But today we're going to talk business. And one of the things that fascinates every investor, every person who has an interest in studying personalities who have done so well, is that there has been a playbook. There is supposedly a secret sauce. In your case, I want to know, what is it that attracts you to a project or an investment branch or a business? Because it's not like you have had your favorites. You have jewelry, you have media on one side, fancy, and on the other side, you have real estate, you have your collaborations with international conglomerates where you're taking the real estate business even further. We're looking at edtech, fintech, agri-tech. We are looking at a bunch of things. What is it that attracts you, not just in a sector, but also in the business that you're investing?
It's a very layered and very interesting question. I think if I would evaluate how I approach the whole portfolio, because a lot of places I've actually co-founded companies, I've actually built teams, organizations. Some places I'm a passive investor, but not really so passive, still quite involved.
That never happens.
But I think for me, the primary first step that I take is always to see if the purpose aligns with me or not. I was reading some Vedic literature, and it showed me the 4 pillars of decision-making that really resonate with my life. And it says Vichara, Vivek, Neti, and Vairagya. And it's beautifully described. And how I apply it to my life is that, okay, Vichara is that in my thought process, in my ethos, does this venture fit? Am I proud to be a part of it? Am I proud to feel, do I feel fulfilled doing this? Does it connect with my purpose? The second aspect is Vivek, so what is the right approach for this business? What is the right strategy? You know, how do you look within and figure out which step to say yes to and which step to say no to? The third is neti, not that, neti. So how do you just start the process of elimination and remove all the clutter so you're completely laser focused and you can see the vision? And the fourth is vairagya. And vairagya doesn't mean just sannyas, but it means that you have almost become one with that venture, with that effort. It's just flowing now. It's a state of effulgence. And I love that, and I apply that to my life. So I start with seeing that, is it serving my overall overarching purpose?
Right.
The second thing that I look at is the sector itself. Is it a sunrise sector? Is it a sunset sector? What is the current infrastructure of the company? Is it just an idea? Are they pre-revenue? What's the potential? Can we create some very interesting clutter-breaking ideas that can exponentially scale this company? Because I'm a big fan of scaling, but not the runway scaling kind where you're burning and burning and burning, and then you're like suddenly saying, well, sorry, I'm not a believer in that. I'm quite mitigative in my approach. And then the last most important thing is also the founder or the team. You know, how committed are they? Yeah. How capable are they? For me, if the integrity is really high and the capability is a little lower, I'm still okay to work with that. I'm still okay to help build capacity, build capability, you know, uplift. And a lot of people evolve very quickly into the role. But integrity is a non-negotiable.
You spoke about having the wisdom and the foresight. But equally interesting are the virtues of risk management, risk mitigation, importance of a diversified portfolio. As an investor, what have your learnings been in the last 5 years, learning from your mistakes, perhaps?
Well, I've made a lot of them, but early in my life. I think I was 16, 17 when I built my first stock portfolio. I've always been somebody who's a constant learner. So for me, it was about going and training under somebody, trained under a broker, understood the market, fell prey to tip, lost a substantial chunk of my portfolio in speculation, felt that heartbreak, rebuilt it, swore never to be speculative again, and stuck to that. So I think a lot of it has been a constant journey. What I evaluate today is that your portfolio has to have a balance depending on the state of mind that you're in. Are you young? Are you hungry? Are you at a stage like my father is, where he doesn't just want to be, he doesn't want messing around. He wants one of these wonderful wealth managers to, you know, take his check and give him good returns and not have to worry about it. As long as he's beating inflation, he's happy. So it's the stage that you're at. So I think it requires a combination of steady and sexy. Because if you're all steady, at least at the stage I am at, then there's super FOMO. When you see everybody else going sexy and you're like, oh my God, he made so much and she made so much. So I think you have to find a balance between that. For me, because I drive a lot of my own holdings and I'm very intimately involved, it's different. And sometimes it's a little embarrassing when I'm having a conversation with an exceptional wealth managers like these guys right here who are, you know, taking stock of a much larger portfolio, looking at a very mitigative play. And then I look at the returns that they're really happy or proud of. And then I look at my own returns and I'm like, I don't know if I can do that because I'm, you know, real estate, for example, we have a company called B&W Developments. And in a traditional real estate portfolio, people are very happy with the 10, 12, 13, 14% return. That too, if you're delivering that in dollars, you're a rock star. We've been averaging at 22, 23% return, right? Unlevered to the investors. We work with single-family offices, multi-family offices, institutions, and it's been great. Is natural built-in mitigative mechanisms in there. We look at real values, and I think integrity plays a big role. I sometimes believe that the markets or a business can give you those returns. It's just like a movie. You know, somebody ends up taking a large share of that money. If they're fair and you create a collaborative ecosystem, you're able to uplift a lot of people. I think the question you have to ask yourself when you're managing a business or when you're, and I ask this to all the young entrepreneurs who I work with or who I invest in, I said, do you want to make money or do you want to create wealth? Because money is transactional, but wealth is a relationship. Wealth is bringing stakeholdership, earning loyalty beyond logic. You have investors who will just say, no, I believe in that company. Even if it's a down cycle, even if the markets are tanking right now, I will hold. Because I know the fundamentals of that company, I know the intention and integrity of that company. They will back you. So I think that's been my experience. And that's what I kind of look for in terms of a balanced approach between steady and sexy.
Interesting. Interesting you say that, because a people's first approach is very unique in these times where everybody is moving to digital and rather having the AI approach. What new developments in the sectors excite you? And what are the new sectors that you are interested in now? But having said that, which is that one place which is like, ye mera comfort zone hai, yahan pe investment mera steady rahega?
I think the comfort zone is obviously real estate. I've done real estate in India. I'm very happy, thriving doing real estate in UAE. We've built a large organization now, 400 people working for us. I've built a real estate fund along with that, with a partner from the Indian markets. And we just listed the company also. The fund manager itself was 200 times oversubscribed on listing. So we run $1 billion portfolio in the UAE through the fund structure. And that's mostly last mile completion, distress asset takeover, stuff like that. We were about 25 cents to the dollar below replacement value. So you've got inherent returns that are really solid. Whether you look at a short-term or a long-term view on it, you're solid because it's a ready asset or almost ready asset. On the development side, in B&W Developments, we've scaled the company exponentially over the last 4 years, transitioned from learning the market as a high-stakes broker, looking at acquiring entire buildings, financing that acquisition, and then selling them individually in retail and creating arbitrage, to actually being value builders, where now on a zero-debt portfolio, we have about a 20 billion dirham portfolio, which translates to roughly about, in today's money, 49,000 crores. We're doing collaborative relationships with some large global hospitality brands. One of them, I'm not supposed to talk about it, so one of them could be India's oldest hospitality company, and we're all possibly enjoying their hospitality right now. So that's been the approach, and it's easier to scale there. We've still focused on luxury residential. We haven't gone and tried to compete into Brookfield's pie or into, Blackstone's pie, and we believe in collaborative growth. On the other hand, it's been fun doing something, because I love wearing jewelry. I was fascinated by lab-grown jewelry. In 2.5 years, Solitario. We've built the brand out, taken it to, 7 countries, 23 cities globally. We'll go public second half of this year.
18 stores in India?
18 stores in India, yes. But overall points of sale globally, we've crossed 100 points of sale. I've built that whole strategy, co-founded the company, took it from, Ricky Vasandani, my founder, my younger brother now, single store in Pune, saw the passion, saw the potential, built the strategy, raised the capital, and now we'll take it public this year, and it'll create a substantial value. So, that kind of value creation also gives me a lot of excitement. The same thing that we're doing with iScholar, which is the EdTech company. I have one of my co-founders here, Mahindra. We run a infrastructure consultancy firm. Now that's as varied as can get and sounds really boring, but it's super exciting. So the entire extension of your sea-link from Versova to Virar and then further on to Palghar is being, done. Contribution has been created by Pentacle or the Pune Ring Road. Now, how do we bring AI into that? How do we create digital twins with that? How do we save costs? How do we save time? That's the kind of stuff that I like to drive. That's exciting, to take even a boring, vanilla business and then how do we reimagine that creatively? That's what's exciting to me.
What I find very fascinating is that you are not just somebody from the entertainment business who had the money and said, all right, I'm going to invest here and let the team look at it. You get your hands dirty and you do your academic bit of it also very, very...
I'm a constant learner, I have zero ego. I will sit on the floor and make a 20-year-old my guru if I need to understand something I don't and say, teach me. And I think that's what keeps me in good stead. That's what I enjoy also, because I believe that when you stop learning, you stop growing. When you stop growing, you die.
Yeah, I think curiosity is the best virtue to have. You know, it's the best thing one can do to themselves. Tell me about your Davos experience. Again, curiosity must have taken you there to see what's happening, what's the chatter about, what's the economic landscape is looking like, who are these people who are talking about impact and business. And, you know, I'm sure it's a candy store for an entrepreneur who is just looking at where do I go now, who do I speak to, and, you know, those many days are also not enough.
It was an exceptional experience. I've been invited before, never made it for various reasons. But I think this time it was exciting. I was invited to do something, to be a part of something that I'm very passionate about. The Motwani Jadeja Foundation, created by Professor Motwani, who was one of the founding pillars of Google as we know it. Asha Jadeja, his widow and brilliant lady, she invited me to collaborate in trying to create a bridge between what's happening in the US and India, and create a bridge so that we can create some sort of synergy. And we decided to take a bunch of really cool, really sexy Indian companies to Davos and engage and interact and mentor them and see where they're at. And these are really cool guys. I mean, one of them is building rockets just like SpaceX, and you know, you have the Prime Minister tweeting about it. The other guy is building, you know, satellites at the cheapest possible cost to send them to space. So hardware, you know, that's the exciting part, Mugdha. I mean, India's whole technology sector was largely built on, you know, human man-hour arbitrage. I'll make money in dollars, I will pay in rupees, I will make an arbitrage between that on a per-hour cost, so BPOs or SaaS models, back-channeling through here. But the whole pivot in the last 10 years is so exciting to see from a hardware perspective, from a space tech perspective, from an automotive perspective, design perspective, fashion perspective. You look at the industry, look at the sea change that's coming along. It's so exciting in every sector. I believe there's tremendous growth. We do a lot of work with SMEs. We're doing almost 5 IPOs this year. We have a really strong relationship with Socradamus, which is like our in-house merchant banker that kind of, you know, helps us build the story, build the book, and then we take it to all these big guys to distribute it. But the kind of excitement, we took a small VFX company, public December 26th last year. I rang the bell, and we were 550 times oversubscribed on that. And it's 70% up from, you know, the subscription price even today when the market's taken a beating. And we're not just stopping there. Now we're value building into that in terms of how do we create what's after Nazara in the space of gaming? How do we create an integration of AI within VFX? How do we remove the man-hour story by bringing in massive technology and be able to qualitatively compete with something that's happening in the West? How do we add a gaming angle to it? How do we take Indian stories? I've invested in a very large project to build an Indian ethos story onto main stage, you know, gaming platforms like the PlayStations of the world. So those are the plays that I feel that I want to bridge now. And sitting in the UAE puts me in that unique position to be able to not only put in my capital, but to also raise capital and then eventually build that value on the public market. So I'm not scared or deterred by a bit of a beating or a trend of FIIs leaving India or cashing out. If you do overvalue your company too much, then you're at fault, right? You're making that mistake on day one. You're being greedy. You're not creating wealth. You're just trying to make money. It's a transactional story. But if people come in with you at the right value and they grow with you, they're not going to just run away at, you know, every time the market dips. So I think you pick your investors, just like a film picks its TG, it picks the audience, and then they're loyal to that space. I think investors are also loyal, and I'm seeing phenomenal amount of growth in even the retail investor. So it's not only going to be about mopping up capital, but it's going to be about opening a whole new TGs of capital that are going to come in and participate on a retail basis.
You always spoke about social impact. Philanthropy, your foundation works rigorously. And we are now in an era where nobody can call themselves entrepreneurs. Every single one has to be a social entrepreneur. the definitions are changing, because you just can't be an entrepreneur any longer, whatever business you're doing, because there is a social aspect. Everybody is talking about sustainability. There is responsibility towards climate action. We are talking about reducing the numbers, getting to net zeros and carbon zeros, and all of those numbers are playing a big role in our sustainability narrative. When we talk about impact investments, do you see yourself in the coming time also pushing that? Because it's a difficult business, social responsibility field, A lot of people, they don't really know how that balance sort of comes. And obviously then the world looks up to entrepreneurs like you and take a leaf from your work. Where do you feel impact projects, where you're doing good for the society, but you're also making money, all of it comes together?
So that's a great question. I think I always say that profit is for a quarter, purpose is for life. If you're purpose-driven and you find the smartest, most mitigative way to create value even for investors, I think there's exponential scale to achieve in a country, an ecosystem like India. I've done charitable endeavors since 2002. Right? My very first salary that I made for my very first film company was 3 lakh rupees. And all of that 3 lakh rupees went into saving a young girl's heart when she needed a change in her heart valve and a surgery to do so. And it was a great investment because today she's, in a mid-30s and a mother of 2 living a fulfilled life. And that gives me greater joy than any award on any shelf. They're living and breathing awards and testaments to your purpose in life. But I realized very fast, we scaled a lot of social impact organizations that are purely non-profit. With Cancer Patients Aid Association, we reached 250,000 children over the last 20 years who were fighting pediatric cancer, laborers' children, farmers' children. With Project Devi, we helped save so many underprivileged girls, almost 14,000 underprivileged girls since 2008, from child abuse, slave labor, those kind of environments, empowering them with free food, free education, and free healthcare. But all of these I found are very difficult to scale beyond a point because there's an asking fatigue and there's a giving fatigue. People start to tire from that. It's not relentless and you have to constantly keep pursuing it. So when you build a financial model into it, whether it's going and creating an impact bond structure for large-scale projects where you can collaboratively work with institutions, governments, or whether it's just yourself trying to do something. So in our agri-tech company, our mission was to say, okay, how much can we enhance the farmer's income by taking them direct to market, and how can we build new structures of financing that pulls them out of the yoke of the current financing structures, which are way more expensive than Neeraj's 14% story. There's probably 14% a month kind of structures. So how do you pull that out? And our experience was so exceptional using technology that we were able to, as soon as we decided that we're not going to earn anything from the farmers, we're going to take money from the buyers. We're going to take money from the companies that are using the produce as a raw material, and we're going to be reasonable about it. We're looking at it as a GTV play and looking at taking a small percentage of the transaction value for giving all these services and help the farmers consolidate into FPOs. Today, you've managed to create 32% increase of net revenue to the farmer in less than 2.5, 3 years. And that's the scalable impact. We've already crossed 1,200 crores GTV on that platform. So for me, that gives me a sense of excitement. And there are people willing to give me a larger multiple in terms of value to that GTV now because they're seeing actual socio-economic impact. So then that's the kind of guy I want to go and raise funds from, somebody who recognizes, the institution recognizes the actual impact on the ground and the upliftment. There are sovereign funds in the Middle East that are saying, hey, this could be a very unique way to solve our problem of food security. That's a real issue for us. Why don't we invest with you? So those kind of plays, you have to be innovative and think. You know, it's not one size fits all. You're making an action movie, you know who's going to watch it. You're making a love story, you know who's going to watch it. The same way, I think you have to take a capital approach like that rather than spray and pray.
I love the filmy analogies, which brings me to the second last question, which is films on one side, OTT career, fascinating roles to play. And I'm sure there are entrepreneurial fascinations that, aaj ye karna hai, kal ye karna hai, ye bhi is sector mein bhi ja sakte hain. How is that balance achieved? People talk about work-life balance, but workaholics have none. I know that, being one. But really, how do you decide that, all right, this project, I can give up for this project, and it stands for both the entertainment industry and for your entrepreneurial journey?
Films now are more the passion than the EMI.
Okay.
Right? They're not the primary source of money anymore. God has put me in a great position where I'm able to now enjoy my passion, choose what expression of cinema I want to be a part of. But in terms of balance, look, it's a tough question for anyone, right? My thesis is that, humanity thrives in harmony. And harmony cannot be achieved without balance. But balance, unfortunately, is not a perfect or constant state. It's this continuous negotiation. Right? You're constantly negotiating with yourself, saying, should I not? If I do this, I have too much on my plate. I have to say no. So that's a tough one every single time, because I'll tell myself, no more. I'm done. I have too much on my plate now. But the minute I reverse my position and sit and look at the entrepreneur and say, forget my excitement. Am I going to back this guy? Am I going to do him justice or her justice? Will I really be able to give this, that scale, that value, that time, that personal attention, not just writing a check? And then that gives me clarity. It allows me to stop being an excited kid and say, no, I'm doing a disservice to this person. I'd rather say no, because I can't give 100% of myself, and say, look, I think I should connect you with somebody else, and then, help the ecosystem grow. So I take that approach, and I've created a new formula for my life. So it's moved on from ROE and ROI, which you guys have discussed all evening. It's moved on to ROTI, return on time invested. So for me now, everything I apply my ROTI formula and think that, if I'm spending the same amount of time watching my kids grow, playing with them in the backyard, or, taking them for a great sporting event, what's the return on time invested quotient, not just financially, but in a holistic approach of life. Beyond the point, you have the cars, you have the house, you have the money in the bank, you've created securities, you've created the wealth for yourself, which is generational now. Beyond the point, you have to learn to say, this is enough, and I am content, I am fulfilled. Otherwise, it's just a constant chase of greed.
That brings me to my last question, which is, many actors talk about leaving behind iconic roles. Entrepreneurs talk about legacy. When people will look back at your journey, what would you want them to see? Your legacy as an actor, your legacy as an entrepreneur? I know it's a tough one, but...
I'd actually like them to see my legacy as a human being. I would truly believe, I think I have 60-odd awards on the shelves. And when I sit back in Zen observation mode, I see my staff coming in and dusting the shelves and taking the dust off these trophies. And when I look at what I've achieved in being an enabler, the impact I've achieved right from the bottom of the pyramid to the middle of the pyramid, the lives I've been able to impact. I was in Paris at an event, and I suddenly had some kid scream out from the audience, Vivekanna, Vivekanna. He was really emotional. And this was like 2016 or 17. And he was a kid that I helped save in 2004 when I rebuilt the village after the tsunami, and literally took him to hospital, helped him financially, set up a school for the village.
Remember that time we covered a lot.
So when I did that, and then I see this kid, I don't know, 10, 12, 14 years later, come up to me, and security is trying to stop him, and I'm saying, let him come, and he just wants to come and give me a hug. And he says that, I've been waiting all my life to thank you. I haven't seen you since then, since you left the village. That brought tears to my eyes. That fulfills me beyond any net worth or filmography. That fulfills me, and maybe that's just for me, but that to me defines purpose. How many tears can you wipe? How many smiles can you light up? You know, I think if you can measure that in your life, how many times when people, like to me, my idol, my icon has been Ratan Tata. I met Tata Saab 2006 or 7. He helped me with CPAA and Tata Memorial Hospital, just encouraged me to do the non-profit work, wrote a personal note to me, you know, in his busy schedule, always kept in touch. And when he passed on, it wasn't how much wealth he created, how many people he employed. It wasn't about, you know, what awards he won. Nothing mattered. Ratan Tata was just overall great human being. You knew him for the impact. You knew him for the purpose-driven qualities that Tata exemplifies. That to me is the icon to look up to.
Wonderful. So I'm just going to quote you and say, profit is for a quarter, popularity perhaps 6 months, a year after you do a very, very big iconic role. But after 6 months, public memory sort of flickers. But purpose is for life.
I love it. You just added another P in my quote. I love it.
Thank you so much, Vivek,
you,
for giving us your time and for all the insights and for being such an inspiring figure in India, who is not just winning hearts with what you do on screen, but also off screen, which is a larger part of your life portfolio. Thank you so much.
Such a pleasure.
Thank you. Ladies and gentlemen, that was Vivek Oberoi, and I don't think I can add anything more after this fantastic conversation that I just had with him. With that, ladies and gentlemen, it's a close to the Mumbai chapter of HSBC presents HSBC India Investment Summit, Alternative Investments and Global Markets in association with CNBC TV18.com. A huge thank you to each one of you for being such a wonderful audience. Now let's continue our conversations over dinner and cocktails. Thank you so much. Have a wonderful night. Thank you.